You know that feeling when you wake up, pour your coffee, open your brokerage app, and just see a total sea of green?
Oh, yeah, it's like a biological sense of comfort.
Right. It is Thursday morning, July 30th, 2026. The opening bell hasn't even rung yet, and if you just glance at the surface today, everything looks incredibly peaceful.
Hmm.
I'm looking at the S&P 500 futures, and they're edging up about 0.3%. The Nasdaq 100 futures are leading the way, up 0.5%. It just, it feels safe.
Well, that surface level green is powerful camouflage,
Yeah.
right? We are wired to interpret upward movement as a sign that the coast is clear.
Yeah, but the reality is that the coast is absolutely not clear.
Not at all.
Because if you just dip your head under the water this morning, Wall Street is a complete battleground. There is a massive structural earthquake happening just below those green numbers.
A huge one.
And that is our mission for today's deep dive. Whether you are actively managing your own portfolio or you're just trying to understand the macroeconomic forces shaping the world right now, this is going to be your shortcut. We are going to decode the institutional strategy briefs and all this pre-market data to figure out if this morning's rally is, genuine or if we're staring down the barrel of a dangerous liquidity trap.
Yeah, because we are dealing with three colliding forces today. The Federal Reserve is showing unprecedented internal fractures.
Right.
We also have a historic divergence between two tech giants, Microsoft and Meta. And underneath every single stock price, the bond market is aggressively rewriting the rules of what companies are actually worth.
So I want to start with the Federal Reserve because that feels like the anchor dragging everything else down right now.
It really is.
The headline from yesterday is that the Fed held rates unchanged. They kept them in the 3.50 to 3.75% range.
Right, which sounds totally normal.
Yeah, as an everyday observer, a rate hold sounds boring. It sounds like the status quo. I would assume the market would just shrug and move on. So why is a simple, hold causing 30-year Treasury yields to violently spike past 5.20%?
Because the panic isn't about the rate they settled on. It's about the fracture in the voting room itself.
Oh, interesting.
Yeah, central banks usually prize unity, right? They want to project a steady, unanimous hand on the steering wheel. But yesterday's decision came down to a 9-3 vote.
Wait, a 9-3 vote?
Yeah, exactly. 3 dissenting members of the Federal Open Market Committee basically broke ranks and demanded an immediate 25 basis point rate hike.
3 dissenters pounding the table for higher rates. That feels incredibly rare for an institution that literally hates surprising the public.
It is rare. And the bond market took it as a massive warning flare. Those 3 votes signal that internal anxiety over inflation is peaking.
Because everyone just assumed inflation was done, right?
Right. The assumption was that inflation was cooling off.
Right.
But this dissent suggests it is actually sticky.
Huh.
And then you add in the geopolitical backdrop. We have U.S. retaliatory strikes in the Middle East, and Brent crude oil is hovering near $90 a barrel.
Wow, $90.
Yeah, and energy costs are volatile, which feeds directly into inflation.
Yeah.
So the bond market looked at that 9-3 vote and realized the era of rate hikes might not actually be over.
And the reaction in the bond market was immediate. I saw the 10-year Treasury yield is now sitting at 4.70%.
Yep.
And like you said, the 30-year is at multi-year highs past 5.2%. But I want to bridge the gap here for anyone listening. Why does the stock market care so deeply about the bond market?
It's all about the time value of money.
Right. If I own shares in a technology company, why does a 4.70% yield on a government bond make Wall Street executives sweat?
Well, think about what you are actually buying when you purchase a high-growth tech stock. You aren't buying the company for the cash they have in the bank today.
No, you're buying the future.
Exactly. You are paying a premium for the promise of massive profits projected 5, 10, or 15 years into the future.
Yeah.
But money has a time value.
Okay, break that down for me. Time value.
So if the U.S. government, which is considered, a risk-free investment, is offering to pay you a guaranteed 4.70% return every single year for a decade, the hurdle for investing in a risky stock goes way up.
Because why take the risk if I can get a guaranteed 4.7?
Precisely. Institutional money managers use a formula called a discount rate to figure out what those future profits are worth in today's dollars. When the risk-free rate jumps to 4.70%, those future tech profits shrink dramatically in value.
Oh, wow.
It acts like a gravitational pull. The higher the bond yield goes, the heavier the gravity dragging down tech valuations.
That brings us perfectly to the split screen we're seeing in big tech this morning, because we can actually see that gravity hitting two specific companies in real time, and the contrast is wild.
It's historic, honestly.
Yeah, Microsoft and Meta are having wildly different mornings. I'm looking at the general trends, and it looks like Microsoft is flying while Meta is plummeting. What do the actual numbers look like under the hood?
Okay, so Microsoft is jumping nearly 9% in the pre-market. Yeah, they're currently testing a major resistance level around $450 to $460 a share.
And support is where?
Structural support is down at $415 to $420. But the underlying catalyst here is purely fundamental. They crushed their Q4 estimates.
I saw that. And the standout number is their Azure cloud revenue.
Right, exactly. Azure accelerated by 43% year over year.
43% for a company of Microsoft's scale is almost hard to comprehend.
It really is.
But then we have Meta platforms. I saw they are tumbling pre-market down over 7.5%, maybe 8%.
Yeah, they are sinking to around $542 a share right now. And the details of their earnings report are honestly fascinating.
Why is that?
Well, Meta actually posted a massive revenue beat. They brought in $60.880 billion, up 28% from last year.
60.8 billion. Okay.
And they boasted 3.60 billion daily active users, with ad impressions up 14%.
Wait, so 60 billion in revenue, massive user growth, ad impressions are up. By all normal metrics, that sounds like a total blowout quarter.
You'd think so, right?
Yeah. So why is Wall Street punishing them with an 8% drop?
The punishment comes down to earnings per share. Their EPS completely missed estimates, coming in at $6.18 against an expected $7.22.
Oh, that's a big miss. Why did they miss so badly?
Unconstrained spending. Their quarterly capital expenditures spiked to $31.08 billion.
Just in one quarter.
Just one quarter, which crushed their operating margins down to 31%. But the real shockwave, the thing that really terrified the market, was their forward guidance.
What did they say?
Meta announced they are ramping up their full-year CapEx to an eye-watering $130 to $145 billion, almost exclusively for AI infrastructure.
$145 billion.
Yeah.
It's like two students turning in a massive group project. Microsoft got an A+ because they actually showed their work.
That's a great way to put it.
Right. That 43% Azure growth proves that all the billions they poured into AI are paying off right now in real enterprise revenue. Customers are literally paying for the product today.
Yes, exactly.
But Meta, on the other hand, turned in their project, got a C- on profitability, and instead of showing their work, they just asked their parents for an extra $145 billion in allowance to build servers for next year.
That analogy captures the exact sentiment of institutional managers this morning. We are seeing a profound shift in what Wall Street is willing to tolerate.
They've lost their patience.
Completely. Money isn't fleeing the tech sector entirely. It is being ruthlessly rotated from one side of the room to the other.
So institutions are rewarding the immediate monetization of AI with Microsoft, and they are essentially putting Meta in the penalty box for asking for too much trust.
That is the core dynamic. In a world where you can get 4.70% risk-free from the government, investors are demanding immediate margin protection.
Right.
They are absolutely unwilling to wait out a multi-year $145 billion spending spree just to see if Mark Zuckerberg's AI infrastructure eventually turns a profit.
Is there any hope for Meta today, like a price floor?
Well, Meta does have a potential floor built on its massive daily active user base, perhaps around the $518 to $520 mark.
Maybe 518.
But if that psychological support breaks, we could easily see a slide down to $500.
Wow. Okay, so if the big institutional money managers are dumping high-spending tech models, where else are they hiding their cash? Because I was looking at the pre-market movers, and there's a company surging today that wouldn't normally associate with massive tech rallies.
You're talking about GRMN.
Yes. Garmin is up over 16%. Garmin, the company that makes smartwatches and aviation GPS systems.
Yep.
Is there a connection there to this whole macro story?
There is a direct connection. Garmin is a textbook example of sector rotation in a high interest rate environment.
Okay, explain that.
Institutions are looking for tangible products with clear, understandable cash flows. Garmin had a blowout second quarter, but more importantly, they raised their full year 2026 revenue and margin guidance.
So it's not just a good quarter, it's a good outlook.
Exactly. They make physical hardware, people buy it, and the profit margins are expanding today, not 5 years from now.
So it's a flight to reality, tangible goods over abstract AI promises.
Yes. Institutional capital is migrating toward high-visibility earnings winners. Garmin's upside target is now $185 to $190.
That's a huge move.
It is. However, I will note that because the stock spiked so rapidly overnight, it has entered what we call overbought conditions, meaning it could experience a gap-fill drop back down to the $155 to $160 range.
Okay, time out. Gap fill drop. Translate that for those of us who don't spend our days staring at candlestick charts. What actually happens in a gap fill?
Sure. When a stock surges violently after hours or pre-market, it literally creates a blank space, a gap on the price chart where no trading occurred.
Oh, I see.
It jumped from, say, 160 directly to 180.
Yeah.
A lot of algorithms and technical traders view those gaps as vacuums that eventually need to be filled.
Meaning the price has to go back down.
Right. When the initial excitement fades, the price often drifts back down to trade at those skipped levels, filling the gap before establishing its true direction.
That makes total sense. And this brings up another phrase I see thrown around a lot on mornings like this: high beta growth stocks. You mentioned institutions are rotating away from them. Give me the explain like I'm 5 for high beta.
Beta is simply a measurement of volatility compared to the broader market.
Okay.
The S&P 500 always has a beta of 1. If a stock has a beta of 1.5, it means it is 50% more volatile than the market.
So if the market drops 1%, that stock usually drops 1.5%.
Exactly. High beta growth stocks are usually tech companies that promise massive future growth but swing wildly in price. When bond yields spike to 4.7%, those high beta stocks are the first things institutions sell.
Because the volatility is no longer worth the risk.
Precisely.
Let's zoom out and look at the broader market, because this Garmin and Microsoft strength seems to be propping up the entire index. I want to talk about the lines in the sand for the S&P 500 and the Nasdaq today. What are the critical levels we need to watch?
Well, for the S&P 500 futures, they are hovering in the 7,360 to 7,365 range right now.
Okay.
The ultimate ceiling, the major resistance zone, is between 7,390 and 7,420. On the downside, critical support is sitting at 7,315 to 7,325.
And if that breaks?
If the S&P drops below 7,315, we are looking at a structural slide down to 7,250.
Wow. I want to focus on that upper boundary you mentioned, 7,420. Why does that specific number matter? Why not 7,400 or 7,402? Like, what is physically happening at the 7,420 level?
The 7,420 level is what we call a major supply overlay. Before the Federal Reserve announcement yesterday, the market was trading above this level.
Oh, I see.
When the 9-3 vote came out, panic set in, and the market aggressively sold off, crashing right through that floor. Now 7,420 acts as a ceiling.
Because everyone who bought there is trapped.
Yes. There are massive institutional trading algorithms programmed to automatically sell if the price reaches that level again, simply to offload risk.
That makes sense.
Bulls have to muster enough buying power to chew through all of those automated sell orders just to invalidate yesterday's 1.5% drop.
And what about the Nasdaq 100? It's currently at 0.5%, which looks strong on the surface.
The Nasdaq is heavily weighted toward tech, so it is being artificially buoyed by Microsoft's massive move.
Of course.
But it is facing intense resistance at the 24,900 to 25,000 zone. It desperately needs to reclaim 25,000 to flip its momentum.
And the floor.
The floor for the Nasdaq is 24,500 to 24,600. If that support breaks, we risk accelerating the tech pullback down to 24,100.
So if I am synthesizing all of this, I mean, we have a fractured Fed, 30-year yield surging past 5.2%, and a market that is being artificially held up by Microsoft while Meta plunges. What is the final verdict on this morning's green ticker? Is this an actual recovery?
The data suggests this is a textbook liquidity trap. Some traders call it a dead cat bounce.
A liquidity trap. So It looks like a rally, it feels like a rally, but it's actually quicksand.
The green pre-market numbers are incredibly deceptive. They are being driven by a single corporate catalyst, Microsoft, rather than broad-based institutional buying across the economy.
Right.
Those surging long-term bond yields and the pressure from $90 crude oil act as an absolute hard cap on equity multiples.
So the ceiling is hard.
Very hard. Until the S&P clearly breaks through that algorithmic buzzsaw at 7,420, any rally today is highly vulnerable to being aggressively sold into by big funds trying to reduce their exposure.
Which brings us to what I think is the most dangerous dynamic of the day for the everyday listener, the retail pain trade.
Yes, the pain trade.
We've established that the market is fragile and institutional money is rotating. Why is this specific morning so uniquely treacherous for the average person trading on their phone?
It comes down to a fundamental mismatch in how retail investors and institutional money managers evaluate a company's health. To understand the track, we first have to look at the US dollar index, the DXY. It's up 0.16% today, sitting at 101.05.
So the dollar is gaining strength against other global currencies. How does a strong dollar hurt retail investors buying tech stocks?
Here is how the trap snaps shut. Retail investors often buy tech dips based purely on top-line earnings beats or exciting consumer narratives.
They see a headline and react.
Exactly. An institutional trader, on the other hand, evaluates the macroeconomic headwinds, specifically the discount rate and foreign exchange impacts.
Let me make sure I am tracking this. If you are a retail trader, you open your app, you see Meta had a massive 28% jump in revenue to $60 billion. You see user growth is up and you think, wow, the stock is down 8%. This is an overreaction. I should buy the dip.
Right, that's the natural instinct.
But the institutional trader sitting at a Bloomberg terminal looks at that exact same revenue beat, looks over at the 10-year Treasury sitting at 4.7%, and decides to sell. Why?
Because the institutional money manager does not need to take on the risk.
Right.
When the risk-free rate is 4.70%, they don't need to stretch for equity risk premiums in tech stocks that are trading at 30 times their earnings. They can simply rotate out of speculative growth and into what we call short-duration treasuries.
I want to pause on short-duration treasuries. Give me the quick definition.
Short-duration treasuries are U.S. government bonds that mature very quickly, usually in a few months to a couple of years.
Okay.
They are virtually immune to long-term inflation fears because you get your cash back so quickly, and right now, they are paying fantastic interest rates.
Ah, I see.
So institutions park billions of dollars there to get a guaranteed return without the headache of worrying about Mark Zuckerberg's $145 billion server farms.
That makes perfect sense. They take the safe, high yield. But earlier you brought up the US dollar index, the DXY, being up to 101.05. How does the currency exchange rate factor into this institutional sell-off?
It creates a vice grip on multinational companies. Think about where big tech companies make their money. If you are selling software or running ads in Europe or Asia, you get paid in euros or yen.
Ugh, I see where this is going. If the US dollar gets stronger, then when those companies bring their European profits back to the US, those euros buy fewer dollars.
That is the exact mechanism. A strong dollar dilutes international revenue.
Ouch.
Yeah, so you have a strong dollar acting as a massive headwind on top-line earnings, while simultaneously a 4.70% bond yield shrinks the present value of their future cash flows.
Double whammy.
Exactly. That combination puts an absolute ceiling on how much investors are willing to pay for a stock. A tech company can beat revenue estimates all day long, but in this macro environment, the stock can still re-rate lower or just trade sideways.
Retail buys the narrative, institutions trade the math.
Yep.
That feels like the defining lesson of this entire deep dive. Today's market isn't a beauty contest about who has the coolest AI tech or the most daily active users. It is entirely about the brutal, unforgiving math of capital costs, margin protection, and algorithmic levels like that 7,420 mark on the S&P.
Well said. The era of zero interest rate free money is dead. The market is demanding that these companies prove their profitability today, not 10 years from now.
Which leaves us with one final massive domino left to fall. Apple and Amazon are reporting their earnings tonight, right after the closing bell.
That's going to be huge.
Oh, massive. And for everyone listening, as you watch those numbers roll in, I want you to ask yourself, will Apple and Amazon validate Microsoft's narrative of profitable, real-world AI adoption? Or will they fall into Meta's trap of endless, unrewarded capital spending?
It is the most critical question of the quarter. I mean, if rates stay elevated, we have to wonder how long big tech can actually sustain this AI revolution before the bond market simply forces them to pull the plug on the spending.
It's a heavy thought to end on, but a necessary one. So the next time you look at that pre-market ticker and see a sea of green, just remember, a calm surface doesn't mean the ocean is safe. Sometimes it just means the real battle is happening deep underwater, right where you can't see it. Stay sharp out there.